Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, today I want to talk about a very interesting metric that Goldman Sachs, one of the largest, most respected investment banking firms in the world, has created. And I think it's an important indicator that I'd like to share with you. And Goldman Sachs has something called the bear market probability model that is an indication of where they think the current stock market cycle is, and in terms of the probability of us having a, quote, bear market. Now, let's take a step back. What's a bear market? Well, technically a bear market is when an indices like the S&P, the NASDAQ, or Dow drops 20% or further from a recent market high. So just imagine the S&P drops 20% or more from a recent high. Technically, you're in a bear market. So again, Goldman Sachs has a metric that they call the probability model, where since 1950, they've had this metric, and they've identified when there's more likely than not going to be a bear market. So and you can look this up, you can just Google this. So the metric combines the components of the U.S. unemployment rate, ISM manufacturing data, the U.S. yield curve, U.S. inflation rate, and the S&P price to earnings ratio. So based on those 5 metrics, they put together a probability model and effectively come up with odds that will favor or not favor the likelihood of us having a bear market. So right now, the indicator is flashing that there's at least since 1950, we're in the top 10% in terms of likelihood that we're going to enter a bear market. Now, will this model be precise or accurate? No one knows. There's not one metric or models that is sort of the tell-all model. But here's the point I wanted to mention to you. Whether this model is right, that we're going to have a bear market, again, a decline of 20% or more from a recent indice high or not, is, in my opinion, not the point. The point is, are you prepared to protect your capital if this model is accurate? Okay? Again, we talk about ways to hedge your portfolio. You could raise cash, i.e. sell stocks if you're in the equity market. You can create a diversified portfolio, but here's the key. A lot of times people think they have a diversified portfolio and they may not necessarily be in the right investments to hedge, or maybe the diversification is not really what you think it is. Again, most people own traditional stocks or bonds. So is it right to even be in the stock market right now? Or if you have money in cash, is it smart to even put it to work? Again, per this indication, per Goldman Sachs, the indication is flashing that there's a higher probability of a bear market. So again, my message to you is, whether this metric is right or wrong, if it's right, are you prepared to protect your portfolio? If you are a current client of ours, we talk about hedging and protecting the downside. That's our number one priority. And if you are a client, we made some changes a few weeks ago to better protect the portfolio, because again, we saw the market trending down. Hopefully it stabilizes and head back north. Everyone likes uptrending market, but obviously that doesn't always happen, and especially since the March 2020 lows, we've really just had very small corrections. They've lasted a few days, and it's been nothing but up. So again, my message to you is be proactive, protect your portfolio, because the markets could continue to trend down, and obviously you want to be in a proactive position to make sure you're not giving back all of your gains over the last year and a half. To that end, if you would like a second opinion on your portfolio to make sure you're in the right investments, you're hedged properly, you could send me an email at cnichols@nicholswealth.com, or you can go on our website at nicholswealth.com to learn more about what we do. Thank you again for watching. Bye-bye.